Good day. This is Bruce Sauer from Delta Global, talking to you from Boston. I am going to comment today on the public equity of the shipping companies and investor sentiment towards them. We have believed for some time that the shipping space represents a good key economic indicator, kind of a canary in the coal mine, and offering good insight on global trends in economic growth. So we like to take a look at what the convergence of many of the indicators are telling us at one time. Basically, we like to see the public equities, the BDI, and the forward freight agreement markets always moving in the same direction. Now, generally they move at different speeds, but if we get a confluence of those three factors moving in the same direction for periods of time, then we can be confident that the shipping trends that we're seeing, be it up and down, are likely to continue. So what are they telling us now? Well, the BDI, of course, the physical aspect of the market has been pretty good, been a good performer so far this year, up 30%. And that's very optimistic, we think rightfully so. FFA, on the other hand, has been a bit skeptical. Cape rates, for example, right now in the spot on the BDI are in the $53,000 range in a daily rate, whereas third quarter FFA has been $34,000. So would categorize that as skeptical at the moment. And what about the public performance of the equities? That has been certainly, say, a show me and prove to me attitude. Investors have kept this group on their radar screen in hopes that the 207 and 208 performance would be repeated. But certainly that's been disappointing so far. So two of those indicators are suggesting caution, and it could be seasonal factors. So right now we're a bit cautious over the summertime on what is going to happen in the public shipping equities. So when I look at the performance, a lot of hot money came into the market in 2007 and 2008, chasing dividends, certainly. They were chasing dividends with respect to the tanker space, which yielded 10%, 12%, 15% in some cases. And they were chasing return in the dry bulk space, taking advantage of the high natural volatility and the up part of the cycle to get spectacular returns in some of the dry bulk names. Well, 2010 performance has been muted. Tankers have been up about 5%. Bulkers have been down about double that. At this point, we think tankers are a better bet in the intermediate term because they are closer to returning cash flow to investors in the form of dividends. We do think that will come to the bulk shippers, but it will be later on, probably likely in 2011. The bulkers remain certainly a hot money group that will be chased probably likely sometime in 2011. So when I relate where the shipping cycle is to the performance of the public equities, certainly the day rates have improved dramatically since late 2008 and 2009, and we've had some upside surprises. We've had time charters now in the neighborhood of 2 and 3 years at fairly healthy rates. They were absent for most of 2009. The delivery schedule has been surprisingly passively absorbed. We're to the point now where a ship is being delivered in the Cape sector anyway, almost every other day. And yet the demand, which we felt would come from China early on and as early as late 2008, has simply picked up and taken that delivery schedule in stride and has allowed day rates to rise to the levels of where they are right now. And they are at the upper end of the historical range. They're allowing owners to make good money if they haven't been too optimistic on their new building program. So right now, those day rates look pretty good. Now, as I compare this environment now to the environment of late 2008, 2009, we as managers in the market were looking at such metrics that we hadn't considered before, such as cash, cash available, and cash on the balance sheet. That was certainly a priced for bankruptcy environment where many of the public companies had been down below $10 and even below $5 per share. We're way past that now, we believe. The first stage of the reliquification of the balance sheets in the industry has been complete by such additions of liquidity as IPOs. Private equity has come in to some extent, follow-on offerings by many of these companies, high-yield bonds, and of course the maritime banks have also played a part in this. And so we think the third stage is likely to get to the market probably sometime later in 2010. And that would be, again, resumption of cash flow from the companies to shareholders in the form of dividends. We think this will return to tankers, certainly sooner. Indication today on Sakos Energy Navigation, they've rejiggered their dividend policy from a semi-annual payment to a quarterly, and we think that could be the first step in instituting a more meaningful cash flow dividend to shareholders. We think that will also come to dry bulkers. It will be later in 2011, and we think as the energy markets return later in 2008, that we're going to have the tankers do very, very well. I think one of the other outside influences that we've been looking at has been the currency. The euro certainly has been a negative trend. We think it's probably likely due for a bounce up into the 125, 129 range. Regardless, we don't think that it's got a meaningful impact in the shipping markets in Europe at all. Europe, in our opinion, just adds incremental demand, and this really remains a story about emerging markets and their structural build-out. So focus on that, and I would not get too carried away with what happens to the euro. We do feel, however, market-wise, that the summertime globally is likely to be difficult, and that a good buying opportunity is coming up just before the U.S. election. And it will be a good entry point, we believe, also for shipping equities. They tend to have more natural volatility and thus will likely reach a meaningful low and start to recover later in the fourth quarter and into the first quarter of 2011. So we are optimistic about shipping markets. Seasonally, we've got some challenges right ahead of us. And we still think that we'll have a strong end of the year. Now, I did want to mention a bit about Delta Global. We manage 5 portfolios for Claymore out of Chicago in the basic resource sector, as well as a shipping portfolio. And we launched the Delta Global Shipping Index in August of 2008. That soon became the Claymore Delta Global Shipping ETF under the symbol SEA. As many of you know, that was shut in May. And it was shut for reasons that the management contract was up for vote for shareholders, and try as hard as Claymore was able, they were not able to get a quorum to vote on that new contract. So they are relaunching that, and it should be back up trading under the same symbol, the same index soon, sometime in June. And Delta Global has started to reach out globally into Europe as well as the Far East in hopes of attracting institutional investors and institutional partnerships. We're interested in spreading our expertise in the public equity space. If you do have interest in contacting and having a discussion with us, we're happy to entertain that. My email is brucezarro@Delta Equity, bzarro@Delta Equity. Thank you so much.